So let us now go into a little more detail on a handful of the aforementioned points. Probably right here. I know what to. To search for comparable companies, we pull a data set of 50 company peers. You can find them at page 6 and 7 in the handout. To first select comps, we analyze the peer group, and this scatter plot chart shows growth trend for Chino's peer group over the last 2 years compared to its related EBITDA multiples. The sample of multiples are correlated with the growth trends, and we can see how companies with recent declining growth are traded at lower multiples. Chino's growth trend over the last 2 years has declined by about 16% annually. So to find the company's position more comparable to Chino's state, we looked in that area of this chart, and it's shaded in blue for you. Most of the comparable peers are now trading at the multiples higher than 5 year. You can see. So management comparison to companies trading at 8 times EBITDA might be a little too optimistic. The second scatter plot chart shows operating margin comparison to the peers. Chino's already low margins have declined last year's and is about 3% operating profit on sales. And to find out what companies trade with similar margins, we look in the area shaded again. It is harder to tell here whether there is a correlation between margins and multiples, but the samples are more concentrated around the low margins and low multiples. Next one. We also wanted to share a point shown by the revenue size of the peers. This bar chart shows our sample of peers with the revenue size of the companies compared to the related EBITDA multiples listed in descending orders. There is a clear correlation between revenue size and multiples, where the higher revenue companies usually are traded at higher multiples. And we'll consider that when we now select comparable companies to derive a market approach valuation. So let us now present you an estimated market value derived from the market approach. Taking the previous notes into consideration and looking at comps for Chino's in its present state, we selected 7 companies out of a data set of 50 peers. This could give a better indication of what the companies should be valued at. First, we went ahead and looked for public comps as of the beginning of 2014 in the same industry. Then we sorted the data set after growth trends and looked in the bottom range regarding previous growth performance. Next, we selected the comps after similar profit margins, turnover ratios, leverage standpoint, and in the end, we also sorted out too big and too small companies. So these are the 7 companies we found to be positioned somewhat closer to Chino's present state. We pulled the EV/EBITDA multiples as it best justifies valuing retail companies. This because of the assumption this industry is capital intensive and in need of human labor. While none were completely similar to Chino's, they at least back up the same story that we've been told. And by averaging the 7 EV/EBITDA multiples, we came up with a multiple of 4.9 and a median multiple of 4.6. Even though the outliers are mostly filtered out, we will use the median value of this sample as it is most representative of the central tendency. Next slide. To estimate the market value based on our assumptions of the present state, we ran evaluation. If we multiply the trailing 12-month trailing 12-month multiple from the comps with our trailing EBITDA, we conclude to an estimated enterprise value of $132.7 million. to find the equity value so that we can further compare it and justify the price what Chinos is now trading at, we have to adjust the enterprise value to equity value. To do that, we deduct long-term debt and add back in cash and cash equivalents. And as we want a value per share, we divide the equity value by 10 million shares outstanding and find the per share value to be $10.73. And that's only half of the maybe too optimistic forecasts we were first told about. And it shows no evidence of that high value being feasible. $10 to $11 per share sound about right, knowing where the stock is trading at now. And then there's an awkward break before I even say. Next, we'll look at what we think is more reasonable projections to run an income approach valuation.
Can I read from here?
Yeah.
So it should be the other slide, this slide first.
Oh.
Our income approach valuations are based on the following projections of Chinos financial statement. We have a detailed income statement on page 10 of that details the following projection if you would like to take a look. The following charts are similar to those of Chinos projection. As you can see here, there is the red line represents Chinos forecast and the bar chart represents our forecast, with 2011 and 2012 being the actual value and 2013, 2019 being our projection, with 2019 is the year one of continuing value. You can see the dollar value on the right side of the
Left. You're right, very left.
on the left side of the graph, which is represented in $1,000. So over here, we are using Chinos sales of $500 million instead of their expected sale of $558 because Chinos underperformed the industry, they failed their expectation. So there's no basis for us to believe that they will overperform the industry in the future. And by using industry growth to project their future sales, we are actually adding a premium to their projections. So our projection is also aggressive. Chinos expense is about 95% of their revenue, and based on Chinos expense is about 95% of their revenue, and over here we can see that their 2019 expense is $695 million. Similarly to revenue, there is a huge variance between our EBITDA projection and Chinos' EBITDA projection. Again, our EBITDA forecast is more conservative than Chinos' forecast. However, it is still important to note that it is still very aggressive considering that our projection is based on the industry. This is because we do not believe Chino will be able to turn around and increase their revenue 46% per year. And we did not find any comparable company that were able to do so. Here, EBITDA's projection is forecasted to be $45 million in 2019, with roughly 3% increase per year. Our projection of Chino's sales based on current men's retail clothing industry leads to an operating margin of 5% as compared to Chino's operating margin of 7%, as shown by the red line. Next. In addition to projecting Chino's income statement items, we also projected the balance sheet items in order to effectively calculate free cash flow. Our balance sheet is on page 11 of the report, and our free cash flow projection is on page 12. Each balance sheet item is projected to mirror sales and expense growth based on historical ratio, and as can be seen, our free cash flow formula is less depreciation and amortization, less change in net working capital, less capex. And and this leads to a free cash flow of around 20 million in 2019. Next one. As emphasized earlier, there's no way Chinos will be able to step into all the available platforms such as Boots industry and online industry and be able to turn around all at once. Therefore, we use the same cost of equity of 16.03% from the build-up method and 13.78% from the capital asset pricing model. Next one. This leads to the same WACC of 12.97% using the build-up method and 11.34% using the CAPM method. Furthermore, we also considered other discounts such as discount for lack of marketability and discount for lack of control. But we've decided that neither one apply. For discount of lack of marketability, Chinos is publicly traded, so it is marketable. But for discount of lack of control, ATL Capital is looking to acquire the company as a whole and take it private. Therefore, control premium is applicable if we know for sure that ATL has something to offer to the table. However, based on the given information, there is no details on what they will bring, so we assume that they will continue the business as is. Therefore, if this control is applicable, we believe the premium is already baked into the $20 price offer, so adding it again would double count it. Next one. There is a detailed calculation of this portion on page 14 of the report. As previously mentioned, the industry growth rate is 3.1%, but as pointed out, it's presumptuous to assume that it's presumptuous to apply industry growth to Chinos growth because they underperformed and they're not in the online platform. And the reality is that men's retail clothing industry will decline because it has reached maturity and stores are starting to step into e-commerce platform because of shoppers' convenience. Chinos is currently not utilizing this, so we expect their sale to slow down tremendously to a rate of 0.5% beginning 2019. We chose the build-up method cost of equity to calculate WACC of 12.97% because we feel it most accurately takes into account the risk of investing in a smaller company compared to their industry players, big industry players. This leads to Chinos enterprise value of $141 million. We have a sensitivity analysis on the report showing the value using 3 long-term growth rate and 3 WACC. Yeah, I took that thing out.
Nice.
That's how everybody's matrix will work.
Before this one? Oh no. Oh, then I should take that slide out too, sorry. This one. Chinos price per share is $11.58 using the traditional DCF income approach valuation after taking out their long-term debt and adding cash back in. Next one. Our third valuation approach is also an income approach, but we use an exit EV/EBITDA multiple of 4.6 as explained earlier. Like the traditional DCF valuation, we chose the weighted average cost of capital using the build-up method. And this leads to Chinos enterprise value of $127 million. We also have another sensitivity analysis using the three multiples and 3 WACC for this method. Chinos price per share using this method is $10.20 after taking into account their long-term debt and cash.
Great. We have taken multiple valuations.
Woohoo! Go Michael!
We have taken multiple valuation approaches: a market approach, multiples, an income approach, a traditional DCF, and a hybrid of the two with DCF and an exit multiple. Naturally, we came up with a range of values from as you can see on the floating bar charts, but even the upper range of those values doesn't even come close to ATL's offer, as you can see it as a line represented on the line of $20 per share. However, it's extremely close to Chino's current trading price of $12 per share. We believe that Chino should sell the company to ATL Capital because a 60% premium above the current trading price is a great return on investment for shareholders who are requesting dividends, and it appears that ATL Capital is the great hands and the best owner of Chino's, and it will calm Juan Tia's concern of leaving the company in good hands. Furthermore, not accepting the offer would expose us to potential lawsuits from shareholders. In conclusion, we believe ATL's offer is more than fair, and we propose a sale without entertaining other buyers. In plain English, take your money and run.